All right. My name is Chris Campbell. I'm a practicing CPA and I work with small businesses and individuals to help them pay the least amount of taxes possible while keeping them out of jail. So I wanted to talk about inheriting property. One thing that I'm seeing often amongst my clients as they start to get up in age, they are inheriting property. So they may have parents or older loved ones and pass along and they leave property. So I want to talk a little bit about the tax implications of that and things that may happen to you where you can incur a tax bill and things that you can do to minimize or get rid of your tax bill altogether when it comes to that stuff. So I'm going to refer mostly to real estate. One of the main things that do get passed on to children are the homes. Usually it's the primary home of the parent. And many times it's long time homes, either paid off or close to paid off. And there's a ton of equity in those properties. So what tends to happen if the children go and sell that property, because there's a lot of equity in the property, there's potential for a good amount of taxes. So a couple of pointers with that. One of the things that I've recently seen is coming out of the pandemic. And since the pandemic, one thing I'm seeing is that with a lot of real estate, there's been quite a bit of appreciation in property. So the beautiful thing, what the tax law allows you to do is use what's called a step-up basis. That step-up basis is essentially your adjusted cost. So when you sell your property, the taxable gain, if any, is determined by what you sell the house. Take away any expenses that you incurred. So if there's any realtor fees, transfer fees, you subtract that, and then you subtract what's called your basis, so what you paid for it, but you didn't pay anything for it because it was given to you, but you have to figure out what your basis is, right? So that's the baseline that you use to determine how much taxes you need to pay on the property. Now, the beautiful thing that the IRS allows you to do is use what's called a step-up basis, because it allows you to save a lot of money on taxes. Because if you use the same costs that you used when, let's say, when your parents bought the house, you're probably looking at a ton of gain. So to avoid that, the IRS allows you to use what's called a step-up basis. That step-up basis essentially says that if you inherit property and your cost basis is the fair market value of what the property is worth at the time that loved one has passed away. So to use an example, let's say mom and dad bought a house for $150,000 back in the 60s and they both pass away. They wind up leaving you the house. But at the time that they die, the property is now worth $650,000, right? So you now get to inherit that market value as your basis. So you get that $650,000. Now, if you were to go and sell that property, say for $700,000, then you would have a taxable gain of that $50,000. So you get to use that $650 as your cost basis. And if you sell for anything above that $650, that becomes taxable for you. As you see, it saves you a lot of money versus using what the price was for mom and dad of that $150, right? So saves you a lot there. That eliminates a lot of the gain. But what I've seen happening as of recent and what can happen, and it doesn't create much of an issue. Let's say that you sell the property as soon as you get it, right? Let's say mom or dad pass away, you get the property right away and you turn around and you sell it right away. So that's not going to create much gain because your basis is what the property was worth when they passed away and you sell it right away. So there's not much of a gap there. Now, what can present a problem though is if the parent passes away and the child doesn't get the property right away. So probate occurs, the property goes into probate, and after the extensive process of probate, then the child gets the property. Now, what's created an issue is that as of recent, because of rising real estate costs, there's been a bit of a gap and prices have been appreciating so fast. There's been a big gap between when mom or dad dies and by the time you actually get possession of the property after probate, right? Because probate can take quite some time. If things get complicated, it can take some time to finish up through probate. So with that said, it now creates a big gap. So going back to my example, let's say that you go on using that same example, house is worth $650,000 at the time of mom and dad's death, but then you go through probate. And let's say probate takes a year and a half. Well, over this year and a half, prices have been going up. So by the time you get a hold of the property, now the property is worth 750,000, but your basis is 650,000. So you already have a built-in gain of that 100,000, and there's not much you can do about it. So you have that gain already of 100K already built in as soon as you're even able to sell the property. If you find yourself in this position, a couple of things that you may do to minimize and mitigate that. One, see if you can use principal home sale exclusion. So that exclusion says that you can exclude up to $250,000 in gain from your taxes. So 250K if you're single, and if you're married, it actually goes up to 500K. But there's two caveats with that. In order to qualify for that, prior to selling, you had to at least own the house for 3 years and used it as a primary residence for at least 2 years. So one strategy you can use if you're sitting on a bit of gain is stay at your primary residence, stay there for 2 years, stay there as your primary residence, and make sure that the time that you're staying there, you actually own the property. I've seen situations where people are staying there, but they don't own the property. So you're going to want to make sure that when you're staying there, you actually own the property. That is very important. So you need to do that to qualify. If you do that, ride out the 2 years and then sell it, then you get up to 250,000 in gain tax free. So it's quite generous because it's in gain, not on the sale. So if the house is worth 650, you wind up selling it for 900, that would still be a tax free gain as long as you qualify for that exclusion. If you're single, and it's double that if you're married. That's one thing you can do to eliminate the gain altogether. Now, if you're not in a position to live in the home, maybe you inherited a property, you're just not local, right? And it's not feasible for you to live in the home. So when you're sitting on this built-in gain, you know that you're going to take a hit. Another thing that you may want to do if you know that you're going to take that hit is once you inherited that property, you're going to want to hold on to it for at least a year. The reason why you want to do that is because once you own that property for over a year, you decide to sell, that gain now becomes a long-term gain, which is treated differently than short-term gain. The short-term gain is any asset or property that you've held for less than a year. Once you hit the threshold of owning that property for over a year, then it becomes a long-term capital gain. Tax treatment is very different. If you have a short-term gain, that gain is taxed at your normal tax rate. So if you're in the 24% tax rate, you get taxed at 24%. If you're in the 32% bracket, then that gain on that sale, you're getting taxed at 32%. It's very much in line with what your bracket is. Keep in mind, the capital gain from that sale will feed to increasing your bracket, right? Because that money is included in determining your bracket. So assuming you have other sources of income and you have this sale, this is going to bump up your bracket. So when it's short term like that, it really works against you. Now, if it's a long-term gain, the most that you're going to pay on that is 20%. And that's if you're in the top bracket. I don't remember the bracketing, but if memory serves me correct, the long-term tax brackets are 0, 15, and 20%. So that all depends upon where your bracket is. The most that you're going to pay is 20%. And that's if you're in the higher tax brackets or income. So on that front, you can save a good amount of money simply by just holding on to the property and making sure that it's classified as a long-term gain. So that's a good strategy to use to mitigate, because most may be inclined to say, if you have a property and you don't want anything to do with it, that you just want to get rid of it right away. That strategy works if you obtain the property shortly after the death and then you turned around and got rid of it. That's going to have a minimal impact. But if there's a longer period of time between when mom or dad passed away and you actually sold, gives an opportunity for appreciation, that's when you can run into the problem. A couple of things to keep in mind if you find yourself in that particular situation, and just do a little bit of planning before you make any moves with offloading the property. I hope this was helpful. If you have any more questions about this topic or any other tax or business related questions, feel free to reach out. All right. That's all for now. I'll talk to you in the next one.